The complete story of Intel Capital. One of the most respectful corporate venture capital in Silicon Valley. March 20th, 2000. The Nasdaq peaks at 5,048. The Dotcom bubble has reached its manic crescendo. Venture capitalists are throwing money at anything with a website. Burn rates don't matter. Business models are optional. Just get big fast. At Intel headquarters in Santa Clara, a different kind of investor is making very different calculations. Intel Capital, the chip giant's venture arm, has been investing for 9 years. They've put over $3 billion into more than 800 companies. They're the largest corporate venture investor in the world. But they're not betting on eyeballs or banner ads. They're building an ecosystem. Every investment has one question behind it. Does this company help sell more Intel chips? If the answer is no, they pass. If the answer is yes, they invest strategically, not financially. When the crash comes, and it will come soon, most venture investors will be destroyed. But Intel Capital will be different. They weren't chasing returns. They were building markets. That strategic clarity, that alignment with the mothership's business model, will save them. This moment reveals everything about what made Intel Capital unique. They were never just a venture fund. They were a strategic weapon. An ecosystem builder. A market maker. They used capital not to generate returns, but to create demand for Intel's core products. It was brilliant. It was unprecedented. And it worked for decades. But to understand how they built this machine, we need to go back to 1991, when a small team inside Intel first realized that the future of computing wouldn't be built by Intel alone. It would require thousands of companies working together. And Intel would need to fund many of them to make sure they all used Intel chips. The world that made Intel Capital possible. 1991, America is emerging from recession. The Cold War just ended. Personal computers are becoming mainstream. But the PC industry faces a chicken and egg problem. Hardware needs software. Software needs hardware. Nobody wants to move first. Intel dominates microprocessors. The 386 chip made them the standard. But CEO Andy Grove sees a problem. Intel can make faster chips every year. But if software doesn't keep up, if applications don't demand more processing power, consumers won't upgrade. The cycle breaks. At the same time, the venture capital industry is small and conservative. Total venture investment in 1991 is about $3 billion for the entire year. Most VCs won't touch early-stage technology. Too risky. Too long. Corporate venture capital barely exists. A few companies tried it in the 1980s, and most shut down their programs after losses. This creates a gap. Thousands of small companies need capital to build the next generation of software, hardware, and internet infrastructure. But traditional VCs aren't interested in most of them. These companies are too small, too niche, or too dependent on specific technology platforms. Into this gap steps Intel. Not to make money from venture returns, but to solve a business problem. They need an ecosystem of companies building products that make Intel chips more valuable. They need to fund the companies that will create tomorrow's demand. The man who will architect this strategy is Les Vardas. He's been at Intel since 1968, employee number 3. Hungarian immigrant. PhD in electrical engineering. He helped build Intel's DRAM business in the 1970s. Later, he ran strategic planning. Now, at age 53, Grove gives him a new mission. Figure out how Intel should invest in other companies strategically. Vardas understands something most people miss. Intel's success depends on the entire computing ecosystem thriving. If software companies fail, if networking companies stumble, if internet infrastructure doesn't get built, Intel's chips become less valuable. The whole chain breaks. He starts small. A few $1 million. A handful of investments. The team is just 5 people. They're not trying to be a venture fund. They're trying to be strategic. Every investment must answer one question. Does this help Intel's core business? Does this create demand for more chips, faster chips, better chips? The first investments focus on software companies building applications for Intel-based PCs, graphics programs, database software, networking tools. Each one makes PCs more useful, which drives more PC sales, which drives more chip sales. The loop is elegant. Intel invests a few million. The company succeeds. Millions of people buy PCs with Intel chips inside. Intel makes billions. By 1995, Varda's team has grown to 20 people. They've invested in over 60 companies. The Internet revolution is beginning. Netscape goes public in August 1995. Everyone suddenly realizes the Internet will be huge. And the Internet needs servers. Millions of servers. All running Intel chips. This is Intel Capital's moment. They start investing heavily in Internet infrastructure companies. Networking equipment. Server software. Data centers. Web hosting. Every piece of the Internet stack that needs Intel chips. They are not following trends. They're building the infrastructure that will run on their products. The investment philosophy is clear. Invest in companies that increase demand for Intel products. Invest in companies that adopt Intel technology early. Invest in companies that might become customers or partners. Don't worry about venture returns. Worry about strategic value. If an investment helps sell $1 billion in chips, who cares if the equity returns nothing? This is radically different from traditional venture capital. Sequoia invests to make money for their limited partners. Intel Capital invests to make money for Intel. The metrics are different. The time horizons are different. The risk tolerance is different. If a portfolio company fails but Intel learns something valuable, that's a win. If a portfolio company succeeds but doesn't use Intel chips, that's a loss. By 1998, Intel Capital is investing over $1 billion per year. They have offices in 15 countries. They've invested in over 400 companies. They're the largest corporate venture investor in the world. And they're just getting started. The team includes investment professionals from top venture firms. People like Arvind Sodhani, who joins from Hambrecht & Quist in 1993 and will eventually run Intel Capital for 2 decades. These people understand venture investing. But they also understand Intel's business. That combination is rare. It's the secret. Intel Capital doesn't just write checks. They provide technical support, access to Intel's engineers, introductions to Intel's customers, help with product roadmaps to ensure compatibility with Intel's future chips, marketing support, distribution channels. This value add is real. Portfolio companies that work closely with Intel Capital often succeed at higher rates than comparable companies. But there's a tension. Portfolio companies sometimes want to support chips from AMD or other Intel competitors. Intel Capital's involvement creates pressure to stay Intel exclusive. This helps Intel but can limit the portfolio company's market. Some entrepreneurs resent it. Others appreciate the focus. As the 1990s end, Intel Capital has become an institution. Over 800 investments. Presence in 50 countries. Strategic partnerships with thousands of companies. They've helped build the Internet infrastructure. They've funded the software that makes PCs indispensable. They've created the ecosystem that makes Intel chips the standard. Then comes March 2000. The Nasdaq peaks. And the crash begins. The secret sources of success. Intel Capital's competitive advantage wasn't obvious from outside. Most people saw them as just another corporate venture group. Big company trying to play venture capitalist. Probably would fail like most corporate VC programs. But insiders knew different. Intel Capital had structural advantages no traditional VC could match. The first advantage was strategic alignment. Every investment had to serve Intel's core business. This seems like a constraint, but it was actually liberating. Traditional VCs chase returns wherever they find them. They diversify across sectors. They follow trends. They compete with dozens of other firms for the same deals. Intel Capital only competed for deals that served their strategy. If a company didn't need Intel chips, 50 other VCs could fight over it. Intel Capital moved on. This focus created deal flow. Entrepreneurs building companies in Intel's ecosystem knew Intel Capital could help in ways traditional VCs couldn't. Technical support. Access to Intel's roadmap. Introductions to major customers. Marketing partnerships. Distribution. These weren't just nice-to-haves. For companies dependent on Intel technology, these were game changers. The second advantage was patient capital. Intel Capital didn't need to return cash to limited partners. They reported to Intel's CFO. Their success was measured by strategic impact, not IRR. If an investment took 10 years to pay off, that was fine. If an investment never paid off financially but helped Intel learn about a new market, that was fine too. This patience meant they could invest earlier than traditional VCs. They could support companies through multiple down rounds. They could hold through market crashes. They didn't have the same pressure to exit. Many portfolio companies that would have died without this patient support eventually became successes. Traditional VCs couldn't match this. The third advantage was Intel's technical expertise. Intel Capital's investment team could tap thousands of Intel engineers. If they were evaluating a semiconductor startup, they could get the world's best chip designers to review the technology. If they were evaluating networking equipment, they could access Intel's networking experts. This due diligence capability was unmatched. They caught technical flaws other investors missed. They identified technical brilliance other investors undervalued. This expertise also created value post-investment. Portfolio companies got access to Intel's labs. They could test their products with Intel's chips before public release. They could co-develop technology. They could align their roadmaps with Intel's plans. This technical collaboration often meant the difference between success and failure. The fourth advantage was global reach. By 2000, Intel Capital had offices in 15 countries. They invested in China before most Western VCs understood China. They invested in Israel's tech scene early. They invested in India, Taiwan, Korea, across Europe. This global network meant they saw opportunities others missed. It also meant they could help portfolio companies expand internationally, connecting them with distributors, customers, and partners in dozens of markets. The fifth advantage was brand and ecosystem effects. Being an Intel Capital portfolio company signaled legitimacy. It told customers and partners this company mattered to Intel. It opened doors. It made sales easier. It attracted other investors. As the portfolio grew, network effects kicked in. Portfolio companies worked with each other. They referred customers to each other. They hired from each other. Intel Capital became the center of a self-reinforcing ecosystem. But the real secret wasn't any single advantage. It was the system. Intel Capital built a machine for strategic investing. They hired smart people. They gave them access to Intel's resources. They aligned incentives around strategic value, not just financial returns. They empowered them to move fast. They supported them through failures. They built a culture of learning. The system had clear rules. Every investment must serve Intel's strategy. Every investment must use Intel technology or drive demand for it. Every investment must be in a market Intel cares about. Portfolio companies must engage with Intel beyond just the capital. These rules created focus. They prevented mission creep. They kept the team aligned. The system also had feedback loops. Every investment was reviewed quarterly. What strategic value did this create? What did Intel learn? How many Intel chips did this company buy? What introductions happened? What partnerships formed? These metrics weren't always quantifiable, but they kept everyone honest about whether investments were working strategically. By 2000, this system had produced extraordinary results. Not measured in venture returns, though those were often strong. Measured in ecosystem impact. Intel Capital had helped build the Internet. They'd funded hundreds of companies that collectively bought billions of dollars in Intel chips. They'd created a network of partners and customers that reinforced Intel's dominance. They'd learned about emerging markets and technologies before competitors. When people asked what made Intel Capital special, the answer was simple. Strategic clarity. They knew exactly why they existed. They measured themselves against that mission. They built a system that delivered on it. They had advantages that came from being part of Intel, and they exploited those advantages systematically. They never tried to be Sequoia or Kleiner Perkins. They built something different. Something that worked for Intel's needs. That alignment was the secret. The Dotcom bubble and crash, building an ecosystem in a mania. March 1999. Intel Capital's investment pace accelerates. They're investing over $1 billion per year now. The Internet is exploding. Everyone needs servers. Everyone needs networking equipment. Everyone needs chips. This is exactly what Intel Capital was built for. The team, led by Arvind Sodhani, makes a crucial decision. They will ride the bubble, but strategically. They'll invest in infrastructure companies that will survive the crash. Data centers. Networking equipment makers. Server software. Enterprise applications. They'll mostly avoid pure consumer internet plays. No pet supply websites. No sock puppet companies. Just infrastructure. This discipline comes from their strategic focus. Does this company help sell Intel chips? A consumer e-commerce site might succeed financially, but it doesn't drive meaningful chip demand. A data center company, however, will buy thousands of servers. Each server has Intel chips. That's strategic value. Consider Akamai Technologies. Founded in 1998 by MIT researchers to solve internet congestion problems. They build a content delivery network, a distributed system of servers that cache web content close to users. Fast-growing websites need Akamai to handle traffic spikes. And Akamai needs thousands of servers. All with Intel chips. Intel Capital invests in Akamai's Series B round in early 1999, alongside Battery Ventures and others. The investment is strategic perfection. Akamai will buy massive amounts of Intel hardware. They validate Intel's server chips for the most demanding workloads. They showcase Intel technology. And they solve a real problem that will matter long after the bubble bursts. Akamai goes public in October 1999. The stock soars. Intel Capital's stake multiplies. But more importantly, Akamai becomes one of Intel's largest customers. Over the next 2 decades, they'll spend billions on Intel-based servers. The financial return is nice. The strategic return is transformative. Or consider Broadcom. Founded in 1991 by Henry Samueli and Henry Nicholas to build networking chips. By 1998, they're growing explosively as internet infrastructure demand skyrockets. They need capital to scale manufacturing. Intel Capital invests in Broadcom's late-stage private round in 1998. This is a complex investment. Broadcom competes with Intel in some markets. They make chips too. But they're also complementary. Broadcom's networking chips often work alongside Intel's processors. And Broadcom's success validates the broader semiconductor industry. Intel Capital decides the strategic benefits outweigh the competitive concerns. Broadcom goes public in April 1998. Intel Capital's stake performs well. But the real value is the relationship. Broadcom and Intel collaborate on standards. They co-market solutions. They jointly call on customers. This partnership helps both companies. Intel Capital made it possible. Then there's Inktomi. Founded in 1996 by Berkeley researchers to build search technology and web caching. By 1999, they're powering search for major portals and helping ISPs manage bandwidth. They need servers. Lots of servers. Intel Capital invests in 1997 and doubles down in 1999. Inktomi goes public in June 1998. The stock explodes during the bubble. Intel Capital's stake grows enormously. But again, the strategic value matters more. Inktomi showcases Intel's server chips at scale. They drive demand. They validate Intel's technology for the most demanding internet applications. Intel Capital invests in dozens of companies like these through 1999 and early 2000. Redback Networks for telecom equipment. Juniper Networks for Reuters. Ciena for optical networking. Exodus Communications for data centers. Each investment serves the strategy. Each creates chip demand. Each builds the ecosystem. But there's also pressure to chase financial returns. The bubble is making traditional VCs incredibly rich. Every internet IPO mints new millionaires. Intel Capital's team sees this. Some want to chase those returns too. Some want to invest in the hot consumer internet plays. The purely financial opportunities. Arvind Sodhani and Les Vardas hold the line. Strategic focus. They'll ride the bubble, but only in strategic areas. They'll make money, but only while serving Intel's needs. This discipline is hard. People leave to join traditional VCs. But the core team stays focused. By March 2000, Intel Capital has invested in over 800 companies. The portfolio value has soared. Paper returns are extraordinary. But then the bubble peaks. The Nasdaq starts falling. Within months, it's clear this is not a correction. It's a crash. The crash, when strategy trumped returns. April 2000. The Nasdaq begins its long collapse. Within a month, it's down 25%. Within a year, it will be down 75%. Hundreds of internet companies will fail. Billions in venture capital will evaporate. It's the worst market crash since the Great Depression for technology stocks. Intel Capital's portfolio gets hit hard. Paper valuations collapse. Companies that seemed invincible in February are fighting for survival by June. The portfolio companies burning through cash face a brutal reality. No more funding. No path to profitability. Time to die. Traditional venture firms panic. They stop investing. They triage portfolios, saving only the companies with clear paths to cash flow. They write off dozens of investments. Some firms never recover. The weakest VCs shut down entirely. Limited partners flee venture capital, moving money to safer investments. Intel Capital responds differently. They keep investing. Not at the same pace as the bubble years, but steadily. Why? Because their mission didn't change. The internet crash doesn't mean companies don't need servers. It doesn't mean networking equipment becomes obsolete. It just means valuations corrected. In fact, the crash creates opportunities. Companies that Intel Capital wanted to invest in during the bubble often had expensive valuations. Now those same companies need capital desperately. Intel Capital can invest at better prices, getting more ownership for less money. The strategic value is the same. The cost is lower. This is perfect. Consider their response to the data center crash. Companies like Exodus Communications collapse. Too much debt. Too many empty data centers. Too much capacity built for growth that won't come. Exodus files for bankruptcy in 2001. Other data center companies follow. But Intel Capital recognizes data centers are still needed. The internet isn't going away. Companies still need hosting. The industry overbuilt, but the core need remains. So Intel Capital keeps investing in the survivors. Companies with strong management, reasonable costs, and real customers. These companies can buy capacity from bankrupt competitors at fire-sale prices. They can consolidate the industry. They emerge stronger. The networking equipment sector faces similar dynamics. The bubble funded massive overbuilding of telecom infrastructure. Now telecom companies stop buying equipment. They have too much capacity. Cisco's revenue collapses. So does Juniper's. So does everyone's. Intel Capital's portfolio companies in this sector struggle. But again, Intel Capital takes a long view. The equipment exists, but it will depreciate. Traffic will grow. Eventually, new equipment will be needed. The companies that survive will dominate. Intel Capital supports the strongest ones through the downturn. They provide bridge financing. They make introductions to customers. They help with restructuring. Many survive because of this support. The software sector tells a similar story. Enterprise software companies watched their sales evaporate as IT budgets got slashed. But companies still need software. They still need databases, security tools, and management systems. The good companies with real products and real customers keep growing, just slower. Intel Capital backs these companies. They help them reach profitability. They connect them with Intel's customer base. The crash also validates Intel Capital's strategic focus. Remember all those consumer internet companies they mostly avoided? The ones selling pet supplies and groceries online? Most die. The business models never worked. They were always dependent on endless cheap capital. When that capital disappeared, they collapsed. Intel Capital lost money on some consumer plays they did invest in. But those losses were small compared to what they would have lost had they chased the bubble fully. Their strategic discipline saved them from catastrophic losses. The portfolio companies that served real needs, that built real technology, that drove real chip demand mostly survived. The strategic investments worked. By 2002, the crash bottomed out. Intel Capital's portfolio value had fallen significantly from the peak. But their best companies survived and were positioned to dominate. The ecosystem they built remained intact. The relationships held. The strategic value accumulated over a decade didn't disappear because public market valuations crashed. More importantly, Intel Capital learned crucial lessons. They learned to distinguish between bubble-driven growth and sustainable growth. They learned which business models survive downturns and which don't. They learned which management teams can execute in tough times. These lessons informed every investment for the next 2 decades. The crash also changed Intel Capital's reputation. Traditional VCs who survived the crash were humbled. Many lost credibility. Limited partners questioned their judgment. But Intel Capital's strategic discipline earned respect. They'd stayed focused. They'd supported their companies. They'd maintained their mission while others panicked. Corporate venture capital, often dismissed before, suddenly looked smart. By 2003, as markets stabilized, Intel Capital stood stronger than before. They'd weathered the worst technology crash in history. Their portfolio companies were leaner, tougher, more focused. The ecosystem remained. The strategic advantages compounded. They'd proven that strategic investing, done right, could survive anything. This was just the beginning. Over the next 2 decades, Intel Capital would invest in thousands more companies. They would expand globally. They would help build the mobile revolution, the cloud computing era, and the artificial intelligence age. They would make billions in returns. But more importantly, they would fulfill their core mission, building the ecosystem that makes Intel chips essential. The story of Intel Capital is ultimately the story of strategic clarity surviving chaos. They knew why they existed. They measured themselves against that mission. When the world went crazy with speculation, they stayed disciplined. When the crash came, they stayed the course. That clarity, that alignment, that patience built something that lasted. Something that created value not just for Intel, but for the entire technology industry. That is the real legacy. The global expansion and mobile revolution. 2003 to 2007. The tech industry recovers from the dot-com crash. But the landscape has changed fundamentally. The internet survived, but the business models evolved. Companies now focus on profitability, not just growth. Capital is more cautious. Valuations are more reasonable. And new technology waves are building. Intel Capital adapts to this new world. They've learned from the crash. They're more selective. They focus even more intensely on strategic value. And they see new opportunities emerging globally. China and India are becoming technology powerhouses. Mobile technology is accelerating. New computing paradigms are appearing. Intel Capital positions itself at the center of these trends. The China strategy becomes central. Intel had been investing in China since the mid-1990s, but now they accelerate. China's economy is booming. The government is investing heavily in technology infrastructure. Chinese companies are becoming sophisticated. And China will soon be the world's largest PC market. Intel Capital needs to be there. They open larger offices in Beijing and Shanghai. They hire local investment professionals who understand Chinese business culture. They build relationships with Chinese government officials, university researchers, and entrepreneurs. They invest in Chinese semiconductor companies, software firms, and internet businesses. The goal is clear: make Intel essential to China's technology development. Consider their investment in Semiconductor Manufacturing International Corporation, known as SMIC. Founded in 2000 by Richard Chang to build China's first world-class chip fabrication facility. This is strategically crucial for Intel. If China develops its own advanced chip manufacturing, Chinese companies might not need Intel chips. But if SMIC focuses on manufacturing chips designed by others, including Intel-compatible chips, that's different. Intel Capital invests in SMIC in 2001. The investment is complex. SMIC could become a competitor. But it could also become a partner. Intel Capital bets on partnership. They provide technical advice. They help SMIC navigate the complex semiconductor industry. They introduce SMIC to potential customers. The relationship works. SMIC becomes a major force in chip manufacturing, but remains friendly to Intel's ecosystem. Or consider Baidu, China's leading search engine. Founded in 2000 by Robin Li, a former InfoSeek engineer. By 2004, Baidu is dominating Chinese search, beating Google in market share. They need servers. Lots of servers. And they're using Intel chips. Intel Capital invests in Baidu's late-stage private round in 2004, before their IPO. This investment exemplifies Intel Capital's evolved strategy. Baidu doesn't need Intel's technical help. They're already successful. But the investment deepens the relationship. It ensures Baidu stays committed to Intel chips. It gives Intel insights into China's internet growth. And it provides financial returns when Baidu goes public in 2005. India becomes another focus. India's software industry is exploding. Companies like Infosys, Wipro, and Tata Consultancy Services are becoming global players. Indian startups are emerging in software, business process outsourcing, and technology services. And India will soon be a major consumer market for PCs and mobile devices. Intel Capital invests aggressively in India starting in the early 2000s. They back software companies, IT services firms, and semiconductor design houses. They invest in Indian e-commerce and mobile technology. They help Indian companies expand globally and help global companies enter India. The portfolio grows to over 100 Indian companies by 2010. The strategic logic is identical to China. Build relationships. Create dependency on Intel technology. Gain market insights. Support ecosystem development. The financial returns are secondary. The strategic value is primary. Meanwhile, mobile technology is emerging as the next major platform. In 2007, Apple launches the iPhone. It changes everything. Suddenly, computing is moving from PCs to mobile devices. And those devices don't use Intel chips. They use ARM-based processors from companies like Qualcomm and Samsung. This is an existential threat to Intel. Intel Capital's response is aggressive. They invest heavily in the mobile ecosystem, trying to make Intel relevant. They back mobile application developers, mobile advertising companies, mobile infrastructure providers. They invest in companies building tablets and smartphones. They hope to drive demand for Intel's mobile chips, even though those chips are still catching up to ARM's power efficiency. Consider their investment in Cloudera. Founded in 2008 by former engineers from Google, Yahoo, and Facebook. They're commercializing Hadoop, an open-source system for processing massive datasets. This is big data before big data became a buzzword. And big data needs servers. Lots of servers. Intel Capital invests in Cloudera's Series A round in 2009. This investment perfectly aligns with Intel's strategy. As mobile devices proliferate, they generate enormous amounts of data. That data needs to be stored and analyzed on servers. Intel-based servers. Cloudera makes that possible. Intel Capital helps them grow. Cloudera becomes a major customer for Intel server chips. The investment works on every level. The mobile push also leads to some failures. Intel Capital invests in numerous companies trying to build Intel-based smartphones and tablets. Most fail. The devices are too power-hungry. They can't compete with ARM-based alternatives. Battery life is terrible. Consumers don't want them. Intel spends billions trying to compete in mobile chips, and Intel Capital invests hundreds of millions supporting the ecosystem. It doesn't work. By 2010, it's clear Intel missed mobile. Their chips aren't competitive for smartphones. ARM won that battle. But Intel Capital's broader mobile investments still create value. The mobile advertising companies succeed. The mobile app developers thrive. The mobile infrastructure plays work out. Intel Capital generates strong returns from the mobile wave, even though Intel's chips aren't in phones. This reveals an important evolution. Intel Capital is becoming less dependent on portfolio companies using Intel chips directly. The strategic value now includes learning, relationships, and market intelligence. Even investments that don't drive direct chip sales can serve Intel's strategy by teaching them about new markets and technologies. The financial crisis, another test of strategic discipline. September 2008. Lehman Brothers collapses. The global financial system freezes. Credit markets seize up. The economy enters the worst recession since the 1930s. Stock markets crash. Venture capital funding evaporates. Startups die by the thousands. It's the dot-com crash all over again, but worse because it affects the entire economy. Intel Capital faces another crucible. Their portfolio companies need capital desperately. But Intel itself is struggling. PC sales collapse as consumers and businesses stop spending. Intel's revenue falls sharply. The company announces layoffs. Every division faces budget cuts. Intel Capital could easily be shut down or dramatically reduced. But Intel's leadership, now under CEO Paul Otellini, makes a crucial decision. They will support Intel Capital through the crisis. The strategic logic remains sound. The ecosystem still matters. The relationships still create value. Cutting Intel Capital would save money short-term but destroy value long-term. So they maintain the program. Intel Capital responds to the crisis much like they responded to the dot-com crash. They keep investing, but selectively. They support their strongest portfolio companies through bridge financings. They help companies cut costs and reach profitability. They connect struggling companies with potential acquirers. They triage the portfolio, focusing resources on companies that will survive. The cloud computing wave is just beginning, and Intel Capital sees the opportunity. Amazon Web Services launched in 2006. Google and Microsoft are building cloud platforms. Startups are rethinking IT infrastructure around cloud services. This is perfect for Intel. Cloud data centers need massive server capacity, all running Intel chips. Intel Capital invests heavily in cloud infrastructure companies during and after the crisis. They back companies building cloud management software, cloud security tools, cloud networking solutions. They invest in companies helping enterprises migrate to the cloud. Every investment drives server demand. Every investment strengthens Intel's position in the data center. Consider their investment in VMware before and after the crisis. VMware pioneered virtualization, letting multiple virtual servers run on one physical server. This is fundamental to cloud computing. Intel Capital had invested in VMware in the late 1990s, before VMware was acquired by EMC in 2004. But they maintained the relationship. They collaborated on technology. They jointly marketed solutions. They ensured VMware's virtualization software ran best on Intel chips. This relationship paid enormous dividends during the cloud era. As companies built cloud infrastructure, VMware's software became standard. And VMware's software ran on Intel-based servers. The ecosystem Intel Capital helped build in the 1990s enabled Intel's dominance in cloud data centers in the 2010s. Strategic investments made 15 years earlier still created value. Or consider their investments in data center infrastructure companies during the crisis. Companies building servers, storage systems, and networking equipment specifically for cloud data centers. Intel Capital backed multiple companies in this space. When the economy recovered and cloud computing exploded, these companies became major Intel customers. The crisis-era investments positioned Intel perfectly for the cloud boom. The financial crisis also accelerated consolidation. Many startups failed. Others sold themselves cheaply. Intel Capital helped orchestrate acquisitions of their portfolio companies, often by other portfolio companies or by Intel itself. This preserved strategic value even when financial returns were poor. The technology, talent, and relationships moved to surviving companies where they continued serving Intel's needs. By 2010, the crisis was ending. Intel Capital had survived again. Their portfolio was smaller but stronger. The ecosystem remained intact. And new technology waves were building that would define the next decade. Intel Capital positioned itself to ride these waves while maintaining strategic discipline. The cloud era and artificial intelligence dawn. 2010 to 2015. Cloud computing moves from emerging technology to mainstream infrastructure. Amazon Web Services, Microsoft Azure, and Google Cloud become massive businesses. Enterprises migrate workloads to the cloud. Startups build cloud native from day one. And all of this runs on servers filled with Intel chips. This is Intel's greatest era of data center dominance. Intel Capital invests aggressively in the cloud ecosystem. They back companies at every layer of the stack. Infrastructure as a service. Platform as a service. Software as a service. Development tools. Management platforms. Security solutions. Every investment supports cloud adoption. Every adoption drives Intel server chip sales. The strategy works brilliantly. They also see artificial intelligence emerging. Machine learning algorithms are getting dramatically better. Neural networks are achieving breakthrough results in image recognition, speech recognition, and natural language processing. Google, Facebook, and Microsoft are investing billions in AI research. And AI requires massive computational power. This could be huge for Intel. Intel Capital starts investing in AI companies in the early 2010s. They back companies building AI chips, AI software frameworks, AI applications, and AI infrastructure. They invest across the stack, trying to ensure Intel remains relevant as AI grows. They recognize this could be as big as the internet. Consider their investment in Nirvana Systems. Founded in 2014 by former Qualcomm engineers to build specialized chips for deep learning. Neural networks require different computational patterns than traditional software. Specialized chips can run them much faster and more efficiently. Nirvana aims to build the best deep learning chips. This investment is complex strategically. Nirvana's chips could compete with Intel's processors. But they could also complement them. And Intel needs to understand this technology. Intel Capital invests in Nirvana's Series A round in 2014. They watch the company closely. They learn about deep learning hardware requirements. In 2016, Intel acquires Nirvana for over $400 million. The acquisition brings deep learning expertise into Intel. Intel Capital's investment and relationship made this acquisition possible. Or consider their investments in AI software companies. Companies like Cloudera and Hortonworks, building platforms for processing massive datasets. Or companies building computer vision systems, natural language processing tools, and recommendation engines. These companies need computational power. Intel Capital backs them, helps them optimize for Intel hardware, and drives adoption of AI workloads that favor Intel's architecture. China becomes even more important during this era. Chinese internet companies are becoming global giants. Alibaba, Tencent, and Baidu are among the world's most valuable companies. Chinese smartphone makers like Xiaomi and Huawei are challenging Apple and Samsung. And the Chinese government is investing massively in AI and semiconductor development. Intel Capital must maintain strong relationships in China. They invest in hundreds of Chinese companies through the 2010s. E-commerce platforms, mobile payment systems, social media, gaming, cloud infrastructure, AI applications. The portfolio becomes one of Intel Capital's largest by geography. The strategic value is enormous. China is the world's largest technology market. Being central to China's tech ecosystem is essential for Intel. But tensions are building. The Chinese government wants technological independence. They're subsidizing domestic chip companies. They're pushing Chinese tech companies to use Chinese suppliers. Intel Capital's investments help maintain relationships, but the strategic landscape is shifting. By the late 2010s, it's clear US-China tech relations are becoming more complex. Meanwhile, another threat emerges. ARM-based server chips. For years, Intel dominated data center processors. But ARM's power-efficient architecture is attractive for cloud data centers where electricity costs matter enormously. Companies like Applied Micro, Cavium, and Ampere Computing develop ARM-based server chips. Amazon develops its own ARM server chips called Graviton. This threatens Intel's data center dominance. Intel Capital responds by investing in the ecosystem around Intel server chips. They back companies building software optimized for Intel architectures. They invest in companies that can't easily port to ARM. They support customers who standardize on Intel. They're trying to create switching costs and ecosystem lock-in. It's a defensive strategy, but necessary. The investment pace accelerates. By 2015, Intel Capital is investing over $1.5 billion per year. They've invested in over 1,500 companies cumulatively. They have offices in 20 countries. The team has grown to over 100 investment professionals. They're one of the most active investors in technology globally. But questions are emerging. Is Intel Capital too big? Are they investing in too many companies? Are they maintaining strategic focus? Some portfolio companies complain they don't get enough attention. Some Intel business units question whether the investments are truly strategic. There's pressure to demonstrate clearer connections between investments and chip sales. Arvind Sodhani, who has run Intel Capital since 1998, retires in 2011. Wendell Brooks takes over. Brooks is more operationally focused. He tries to tighten the connection between investments and Intel's business units. He implements more rigorous screening for strategic value. He pushes portfolio companies to engage more deeply with Intel. The program becomes more disciplined. The platform shift, missing mobile, pivoting to data center and AI. 2015 to 2020. Intel faces a strategic crossroads. They've definitively lost mobile. Smartphones and tablets run on ARM chips. Intel's mobile chips never achieved market traction. The company finally admits defeat and exits mobile chip development. This is a massive strategic failure. Mobile computing was supposed to be the next wave after PCs. Intel missed it. But Intel's data center business is booming. Cloud computing drives insatiable demand for server chips. Intel's Xeon processors dominate with over 95% market share. Data center revenue becomes Intel's largest and most profitable segment. Intel Capital refocuses entirely on data center and AI. The investment thesis evolves. Every investment must drive data center chip sales or position Intel for AI. Mobile investments wind down. PC ecosystem investments become maintenance. All new investments focus on cloud, data center, AI, and emerging technologies that will require significant computational power. They invest heavily in autonomous vehicle technology. Self-driving cars will generate enormous amounts of data. That data needs processing. Some processing happens in the car, but much happens in data centers. Training autonomous vehicle AI requires massive computational power. All of this favors Intel. Intel Capital backs companies building autonomous vehicle software, sensor systems, simulation tools, and mapping technologies. In 2017, Intel acquires Mobileye, an Israeli company that makes vision systems for autonomous vehicles. Intel Capital had invested in Mobileye in 2009. They'd maintained a close relationship. When Intel decided to enter autonomous vehicles seriously, Mobileye was the obvious acquisition target. Intel pays over $15 billion. It's one of Intel's largest acquisitions ever. Intel Capital's 8-year relationship made it possible. This pattern repeats across Intel Capital's portfolio. They invest. They build relationships. They learn about markets. Years later, Intel acquires the company or partners deeply. The acquisition of Altera for $16.7 billion in 2015 followed a similar pattern. Intel Capital had invested in Altera in the 1990s. They maintained relationships. When Intel needed FPGA technology for data centers, Altera was the target. AI becomes the dominant investment theme. Intel Capital backs hundreds of AI companies between 2015 and 2020. Computer vision. Natural language processing. Robotics. Healthcare AI. Financial services AI. Manufacturing AI. Autonomous systems. Every vertical where AI can be applied. The bet is simple: AI will drive massive computational demand. That demand will run on Intel chips in data centers. Therefore, fund the AI ecosystem. Some investments work brilliantly. Companies like DataRobot, building automated machine learning platforms, create demand for Intel servers. Companies like Sambanova Systems, building AI-specific computing systems, choose Intel as a partner. These strategic wins justify the program. But challenges mount. NVIDIA emerges as the dominant AI chip company. Their GPUs are far better for training neural networks than Intel's CPUs. By 2018, NVIDIA chips are standard for AI. Intel is scrambling to catch up. Intel Capital invests in companies that might prefer Intel chips, but many AI startups standardize on NVIDIA anyway. The strategic leverage is weaker than in previous eras. The geopolitical situation complicates everything. US-China tech tensions escalate. The Trump administration restricts technology exports to China. Huawei gets blacklisted. Chinese companies face restrictions. Intel Capital's China portfolio becomes more complex. Some Chinese companies can't access US technology. Some face uncertain futures. The strategic value of those relationships diminishes. Intel Capital also faces internal challenges. Intel's core business struggles. PC market growth stalls. Competition intensifies from AMD, whose new Ryzen and EPYC chips are genuinely competitive for the first time in a decade. Intel faces manufacturing delays. The 10-nanometer process is years late. These internal problems distract from Intel Capital's strategic mission. In 2019, Intel Capital hits an important milestone. They announced cumulative investments of over $13 billion in over 1,600 companies since inception. They've had over 700 exits through IPOs and acquisitions. They claim returns of over $8 billion. These numbers are impressive. They demonstrate scale and success. But the program faces questions. Does Intel Capital still create strategic value at this scale? Are they too diversified? Are investments truly moving Intel's business forward? Or has Intel Capital become primarily a financial investor that happens to be owned by Intel? These questions don't have clear answers. Then COVID-19 hits in early 2020. The pandemic transforms everything. Offices close. Work goes remote. Cloud computing demand explodes. Video conferencing becomes essential. E-commerce accelerates. Digital transformation, talked about for years, happens in months. And all of it runs on Intel chips in data centers. It's an extraordinary moment for Intel's data center business. Intel Capital responds by investing heavily in companies enabling remote work and digital transformation. Collaboration software. Cloud security. Network infrastructure. Developer tools. Digital health. Online education. E-commerce platforms. Every investment serves the same strategy: support technologies that drive computing demand. The pandemic validates Intel Capital's data center focus. The transition era, new leadership and new challenges. 2020 to 2024. Intel faces its most challenging period in decades. Manufacturing problems continue. The 10-nanometer process is troubled. 7-nanometer is delayed. Meanwhile, TSMC and Samsung are pulling ahead. AMD continues gaining market share with chips manufactured by TSMC. Apple announces it's ditching Intel chips in Macs, switching to its own ARM-based processors. Intel's stock underperforms. In early 2021, Intel brings in a new CEO, Pat Gelsinger. He's an Intel veteran who left years ago to run VMware. His mandate is simple: fix Intel. He announces a massive investment in manufacturing. Intel will build new fabs in the US and Europe. They'll offer foundry services to other chip companies. They'll get back to manufacturing leadership. It's ambitious and expensive. Intel Capital adapts to this new strategy. The investment focus shifts toward supporting Intel's foundry ambitions. They back companies that might use Intel's manufacturing services. They invest in design tools, IP libraries, and ecosystem technologies that make Intel foundries attractive. They try to build the customer base for Intel's foundry business before that business fully exists. They also double down on AI. NVIDIA may dominate AI training, but Intel believes they can win AI inference, running trained models in production. Inference happens billions of times per day across thousands of applications. It's a huge market. Intel Capital invests in companies that will deploy AI at scale, companies that need inference solutions. They're betting these companies will choose Intel. The investment in Granulate is illustrative. Founded in Israel in 2018, Granulate optimizes application performance on cloud infrastructure. They use AI to analyze how applications run and automatically tune them for better efficiency. This saves companies money on their cloud bills. And crucially, it showcases Intel's chips. Granulate's optimization works especially well on Intel processors. Intel Capital invests, builds a relationship, and in 2022, Intel acquires Granulate. The strategic playbook continues working. The portfolio composition evolves. Less consumer internet. More enterprise infrastructure. Less mobile. More cloud and edge computing. Less geographical diversity as geopolitics makes some markets harder. More focus on strategic alignment. The program is maturing, becoming more selective, more aligned with Intel's narrower strategic priorities. Intel Capital also emphasizes diversity. They announce targets for investing in companies with diverse founders. They launch programs to support women entrepreneurs and underrepresented minorities in tech. This reflects both changing social expectations and sound business. Diverse founders bring different perspectives. They target different markets. They solve different problems. Supporting them expands Intel Capital's strategic reach. By 2023, Intel Capital manages a portfolio of over 500 active companies. They invest around $1 billion per year. They have offices in 10 countries. The team focuses on AI, cloud, edge computing, 5G, and autonomous systems. Every investment aligns with Intel's strategic priorities under Gelsinger's leadership. But the fundamental question remains: can Intel Capital's strategic approach survive Intel's diminished competitive position? When Intel dominated semiconductors, portfolio companies wanted Intel support. Now, with Intel struggling, does Intel Capital offer the same value? The honest answer is uncertain. Some portfolio companies still value Intel Capital highly. Access to Intel's engineers, technology roadmaps, and customer relationships matters. For companies in Intel's remaining strongholds, data centers, and PCs, Intel Capital remains valuable. But for companies in growth areas where Intel is weak, like mobile or AI chips, the value proposition is weaker. Intel Capital's team recognizes this. They emphasize other value adds: financial support, operational guidance, network introductions, help with sales and marketing. These services don't depend on Intel's competitive position. Any well-resourced corporate venture group can provide them. Intel Capital is trying to remain relevant even as Intel's technical leadership erodes. The program also faces existential questions. Intel is spending billions to rebuild manufacturing. Should they redirect Intel Capital's budget toward that effort? Some inside Intel argue yes. Intel Capital defends itself by arguing strategic investments pay off over decades. The Mobileye and Altera acquisitions, both enabled by Intel Capital relationships, created enormous value. Future acquisitions will too. Patience is required. Recent investments. 2024, Intel Capital continues investing actively. The AI boom drives deal flow. Every company claims to use AI. Intel Capital filters aggressively for genuine AI applications that will drive computational demand. They back companies using AI for drug discovery, financial analysis, cybersecurity, and industrial automation. These applications require serious computing power, which helps Intel. They invest in quantum computing companies, positioning for a potential future platform shift. Quantum computers need classical computers for control and pre-processing. If quantum computing succeeds, it will require massive classical computing infrastructure. Intel Capital is ensuring they're connected to leading quantum companies. They also invest in edge computing, processing data closer to where it's generated rather than sending everything to cloud data centers. Autonomous vehicles need edge computing. Factories need it. Smart cities need it. This is strategic because Intel has chips designed for edge applications. Intel Capital backs companies building edge infrastructure and applications. The semiconductor ecosystem gets renewed attention. Intel Capital invests in chip design tools, IP providers, and packaging technologies. These investments support Intel's Foundry strategy. They also keep Intel connected to innovations across the semiconductor industry. If a startup develops breakthrough technology, Intel Capital's relationship makes acquisition easier. Geographically, the focus has shifted. China investments have declined due to geopolitical tensions and regulatory restrictions. US and European investments have increased, aligned with Intel's manufacturing expansion in those regions. Israel remains important, with its strong tech ecosystem. India continues growing as an investment destination. Intel capital has also become more thesis-driven. Rather than reacting to inbound deal flow, they identify strategic areas, develop investment theses, and proactively source companies. This approach ensures tighter alignment with Intel's business strategy. It also means passing on more deals that don't fit the thesis, even if they might generate strong financial returns. The metrics for success continue emphasizing strategic value. How much Intel product did the portfolio company buy? What technology did Intel learn about? What partnerships formed? What acquisitions resulted? Financial returns matter but remain secondary. This is the core of Intel Capital's differentiation. They optimize for different metrics than traditional VCs. Current leadership emphasizes that Intel Capital is not a profit center. It's a strategic tool. The goal is not to generate venture returns, though those are nice. The goal is to build ecosystems, gain market intelligence, and create demand for Intel products. Measured against that goal, Intel Capital has succeeded for over 3 decades. The organization's built and transformed. Intel Capital itself has become an enduring institution. Over 30 years. Over 1,600 investments. Over $13 billion deployed. Over 700 exits. Hundreds of employees over the years. Offices worldwide. This is one of the most successful corporate venture programs ever created. The program has evolved significantly since Les Varda started it in 1991 with 5 people and a few $1 million. It's now a sophisticated global investment organization. It has developed rigorous investment processes. It has built deep networks across the technology industry. It has trained generations of investors who've gone on to lead other corporate venture groups or start their own firms. The culture Intel Capital built emphasizes strategic thinking over pure financial optimization. New investment professionals learn to ask, how does this serve Intel, before asking what returns will this generate? This culture has persisted through multiple leadership changes and market cycles. It's the institutional knowledge that makes Intel Capital work. The program also built a powerful brand. Being an Intel Capital portfolio company signals legitimacy. It tells customers this company matters. It tells other investors this company is strategic. It opens doors. This brand value compounds over time. Each successful portfolio company strengthens the brand. The brand attracts better deal flow. Better deal flow leads to more successful companies. The cycle reinforces itself. Intel Capital has also shaped the broader corporate venture capital industry. When they started in 1991, corporate VC was rare and often unsuccessful. Intel Capital proved corporate venture capital could work if done strategically. They demonstrated that corporations could invest successfully by leveraging their unique advantages rather than trying to copy traditional VCs. Dozens of other corporate venture programs have learned from Intel Capital's model. Portfolio companies Intel Capital helped build have themselves become significant institutions. Broadcom became one of the world's largest semiconductor companies before being acquired. Inktomi was acquired by Yahoo. Akamai became the backbone of internet content delivery. VMware revolutionized data center infrastructure. Mobileye is leading autonomous vehicle technology. Hundreds of other companies have thrived with Intel Capital support. Many of these companies now employ thousands of people. They've created billions in market value. They've developed technologies that power modern computing. They've solved important problems. Intel Capital's strategic investments, driven by Intel's business needs, created enormous spillover benefits for the broader economy. The program has also created a significant alumni network. Investment professionals who worked at Intel Capital have gone on to leadership roles across the venture capital and technology industries. They carry lessons learned at Intel Capital to their new organizations. This diffuses Intel Capital's strategic investment methodology across the industry. Broader impact and legacy. Intel Capital's impact extends far beyond Intel's own success. They helped build the internet infrastructure in the 1990s. They supported the cloud computing revolution in the 2010s. They're now backing the AI era. At each technology inflection point, Intel Capital has been an active participant, funding the ecosystem that makes new platforms possible. They've invested in over 1,600 companies across 50 countries. These companies collectively employ hundreds of thousands of people. They generate hundreds of billions in revenue. They serve billions of customers. While Intel Capital didn't create these companies, they provided capital, support, and strategic guidance that helped many of them succeed. The wealth creation has been substantial. Intel Capital's investments generated strong returns for Intel. Portfolio companies that went public created wealth for founders, employees, and other investors. Acquisitions created liquidity events. The multiplier effect spread widely. Pension funds, university endowments, and individual investors all benefited from Intel Capital's portfolio companies' success. Intel Capital also demonstrated that strategic investing can generate both strategic value and financial returns simultaneously. This challenged conventional wisdom that corporate venture capital must sacrifice returns for strategic benefits. Intel Capital proved you can have both if you're disciplined and patient. Their approach to globalization also influenced how technology companies think about international markets. Intel Capital's early investments in China, India, Israel, and other markets helped Intel understand these markets and build local relationships. This intelligence informed Intel's broader international strategy. Other companies copied this model, using venture investments as market development tools. However, Intel Capital's impact has not been entirely positive. Some critics argue that Intel Capital's investments created dependencies that limited innovation. Portfolio companies that became too reliant on Intel's technology or support sometimes struggled when Intel's competitive position weakened. The strategic strings attached to Intel Capital investments may have constrained some companies' options. There are also questions about whether Intel Capital's success allowed Intel to become complacent. By building such strong ecosystems around their existing products, Intel Capital may have reduced Intel's urgency to innovate. When you have hundreds of companies reinforcing your current platform, it's harder to see threats from new platforms. Intel's failure in mobile might partially result from ecosystem lock-in that Intel Capital helped create. The concentration of Intel Capital's portfolio in companies supporting Intel's architecture also raises questions about market competition and innovation. Did Intel Capital's strategic investments create barriers to entry for competing chip architectures? Did it slow innovation by reinforcing incumbency? These questions don't have simple answers, but they're worth considering. Contemporary relevance and lessons. Today, Intel Capital faces an uncertain future tied to Intel's own challenges. Intel is no longer the unchallenged leader in semiconductors. TSMC leads in manufacturing. NVIDIA dominates AI chips. AMD is genuinely competitive in many markets. Apple, Amazon, Microsoft, and Google are designing their own chips. Intel's position is weaker than any time in decades. This changes Intel Capital's strategic value proposition. When Intel led the industry, portfolio companies wanted Intel's support because it meant access to the best technology and the biggest ecosystem. Now, with Intel catching up rather than leading, the value proposition is less compelling. Intel Capital must work harder to differentiate themselves. But Intel Capital still has advantages. Their patient capital, strategic support, and global network remain valuable. For companies in markets where Intel is still strong, particularly data centers and PCs, Intel Capital remains an attractive partner. And Intel Capital's track record and experience make them credible investors. The program also continues providing Intel with market intelligence and access to innovation. Even if Intel Capital's portfolio companies don't all use Intel chips, they teach Intel about emerging technologies and market trends. This intelligence is valuable for Intel's strategy. Understanding where technology is going matters as much as having the best current products. Intel Capital's story offers lessons for corporate venture capital broadly. First, strategic clarity is essential. Intel Capital succeeded because they knew exactly why they existed and measured themselves against that mission. Corporate venture programs that try to be traditional VCs usually fail. Those that embrace their strategic mission and leverage their unique advantages can succeed. Second, patience matters. Intel Capital's biggest successes often took years or even decades to pay off. The Mobileye acquisition happened 8 years after Intel Capital's initial investment. The ecosystem benefits from 1990s investments continued creating value in the 2020s. Corporate venture capital must take a long view. Third, strategic doesn't mean unprofitable. Intel Capital generated strong financial returns while serving strategic purposes. They didn't sacrifice returns for strategy. They found companies where strategic alignment and financial opportunity intersected. This is the holy grail of corporate venture capital. Fourth, adaptation is crucial. Intel Capital evolved as technology and markets changed. They shifted from PCs to internet to cloud to AI. They expanded geographically as new markets emerged. They adjusted investment strategies as Intel's competitive position changed. Rigid adherence to old strategies would have made them irrelevant. Fifth, relationships compound. Intel Capital's network effects grew over decades. Each successful investment strengthened relationships, which led to better deal flow, which led to more successful investments. Building these networks takes time and consistency. Short-term corporate venture programs can't achieve this. For today's investors, Intel Capital's story illustrates the power of strategic investing combined with patient capital. In an era of increasingly short-term focus, where quarterly earnings dominate decisions, Intel Capital shows that long-term strategic investing can create enormous value. Their success over 3 decades proves that strategic clarity and patience can survive market crashes, technological disruptions, and competitive challenges. The story also raises questions about the role of corporate venture capital in shaping markets and competition. When large corporations invest strategically in their ecosystems, they can reinforce their market positions in ways that might limit competition. This isn't inherently good or bad, but it's a factor in thinking about market dynamics and innovation. Investment lessons from 3 decades. Intel Capital's 3-decade journey offers numerous lessons about investing, strategy, and building enduring institutions. These lessons emerge not from theory but from actual experience navigating multiple technology cycles, market crashes, and competitive shifts. First lesson, strategic alignment creates unique advantages that financial investors cannot match. Intel Capital succeeded because they brought more than money. They brought technical expertise, customer relationships, market access, and ecosystem effects. Portfolio companies valued these non-financial contributions enormously. This allowed Intel Capital to win deals at reasonable valuations and add genuine value post-investment. Traditional VCs without these strategic assets cannot replicate this approach. This lesson emerged clearly during the dot-com bubble. While pure financial VCs fought over deals and paid extreme valuations, Intel Capital maintained discipline. They only invested where strategic value existed. This focus protected them from the worst bubble excesses. When the crash came, their strategic relationships preserved value even as financial valuations collapsed. Second lesson, long-term orientation creates opportunities others miss. Intel Capital could invest in early-stage companies and support them for years or decades. They didn't face pressure to exit within typical fund timeframes. This patient capital proved valuable repeatedly. Many of their best investments took 10 or more years to mature. Traditional VCs would have been forced to sell earlier, leaving value unrealized. The Mobileye investment illustrates this perfectly. Intel Capital invested in 2009. Mobileye was promising but early stage. Most VCs would have exited during Mobileye's IPO in 2014, taking perhaps a 5 to 10 times return. Intel Capital held. In 2017, Intel acquired Mobileye for $15 billion. Intel Capital's long-term hold, enabled by patient capital, maximized both strategic and financial value. Third lesson, ecosystem thinking compounds over time. Intel Capital didn't just invest in individual companies. They built networks of companies that worked together and reinforced Intel's platform. These network effects grew over decades. By the 2000s, Intel Capital's portfolio companies referred business to each other, hired from each other, and collaborated on technology. This created value beyond what individual investments could generate. The Internet infrastructure investments from the 1990s illustrate this. Companies building servers, networking equipment, web hosting, and software all needed each other. Intel Capital connected them. This accelerated the entire ecosystem's development, which increased demand for Intel chips. No single investment could have achieved this. The portfolio effect mattered. Fourth lesson, learning from failure matters more than avoiding failure. Intel Capital made hundreds of failed investments over 30 years. Many portfolio companies died. Many investments lost money. But Intel Capital systematically learned from these failures. They developed better screening criteria. They recognized red flags earlier. They improved their due diligence processes. This continuous learning made them better investors over time. Their mobile investments largely failed. Intel's mobile chips never succeeded. But Intel Capital learned about mobile ecosystems, consumer behavior, and platform competition. This knowledge informed Intel's later strategic decisions, even though the investments didn't generate returns. The learning had strategic value independent of financial outcomes. Fifth lesson, timing and luck matter enormously. Intel Capital launched in 1991, just before the personal computer and internet booms. This timing was fortuitous. They built their program and reputation during a massive growth wave. If they'd launched in 2000, after the crash, building credibility would have been much harder. Good timing made everything easier. Similarly, Intel's dominance during Intel Capital's first 2 decades gave them structural advantages. Portfolio companies needed Intel chips. Intel Capital's support genuinely mattered. As Intel's position weakened in the 2010s and 2020s, Intel Capital's strategic leverage diminished. The same investment strategy became less effective because the underlying competitive dynamics changed. Acknowledging luck's role is important for understanding any success story. Sixth lesson, scaling while maintaining quality is extremely difficult. Intel Capital grew from 5 people investing millions to over 100 people investing billions. At scale, maintaining strategic focus and investment quality became harder. Not every investment professional understood the strategic mission as deeply as the founders. Not every investment received the attention it deserved. Some portfolio companies felt neglected despite being in the portfolio. This scaling challenge affects all successful venture programs. The advantages that work at small scale don't always work at large scale. Intel Capital struggled with this. They implemented more processes and structure to maintain quality. But processes create bureaucracy. Finding the right balance between structure and flexibility remains an ongoing challenge. Seventh lesson, geopolitics can override business strategy. Intel Capital's China investments made strategic sense. China was the world's largest technology market. Building relationships there served Intel's business. But US-China tensions in the late 2010s and 2020s complicated everything. Investments became politically sensitive. Some portfolio companies faced restrictions. Strategic logic collided with geopolitical reality. This lesson applies broadly. Global investing always carries geopolitical risk. Strategies that make sense economically can become impossible politically. Diversification across geographies provides some protection. But when tensions involve the world's 2 largest economies, no portfolio is immune. Intel Capital had to adapt, reducing China exposure and focusing more on allied countries. Eighth lesson, technology platforms shifts create both opportunities and threats. Intel Capital thrived during the PC and Internet eras because those platforms ran on Intel chips. The mobile shift threatened Intel because mobile devices used ARM chips. Intel Capital tried to influence this platform shift through investments, but largely failed. This illustrates the limits of investment strategy in shaping technology adoption. Platform shifts are existential for technology companies. The company and corporate venture program that dominated the previous platform rarely dominate the next one. Intel Capital's experience with mobile mirrors Microsoft's mobile struggles, IBM's PC challenges, and Nokia's smartphone failure. Incumbent advantages become liabilities when platforms shift. Recognizing platform shifts early and adapting quickly is critical. Ninth lesson: strategic and financial goals can conflict. Intel Capital generally aligned strategic and financial objectives successfully. But conflicts arose. Sometimes the strategically best investment offered weak financial returns. Sometimes the financially attractive investment provided minimal strategic value. When these conflicts occurred, Intel Capital usually chose strategy over returns. This was correct given their mission, but it meant leaving money on the table. Traditional VCs don't face this conflict. They optimize purely for returns. This simplifies decision-making. Corporate venture investors must navigate dual objectives. Being clear about priority when conflicts arise is essential. Intel Capital's clarity about prioritizing strategic value enabled consistent decision-making across leadership changes and market cycles. 10th lesson: relationships outlast market cycles. Intel Capital's best investments often came from long-term relationships. They'd meet a founder early, stay in touch for years, and invest when timing aligned. They'd work with portfolio companies through multiple rounds. They'd maintain relationships with successful founders who started new companies. These relationships created compounding advantages over decades. This lesson applies beyond corporate venture capital. In investing and business generally, relationships matter enormously. Trust takes time to build but creates opportunities that transactional relationships cannot. Intel Capital's network, built over 30 years, became their most valuable asset. New entrants cannot replicate this quickly regardless of capital or talent. The essential meaning: Intel Capital's story is ultimately about strategic clarity surviving chaos. For over 3 decades, through technology revolutions, market crashes, competitive disruptions, and internal challenges, Intel Capital maintained its core mission: build ecosystems that make Intel chips essential. They measured themselves against that mission consistently. When the world chased speculation, they stayed disciplined. When crashes came, they stayed strategic. That clarity built something that lasted. But the story also reveals the limits of strategic investing. Intel Capital couldn't save Intel from missing mobile. They couldn't prevent competitors from catching up in manufacturing. They couldn't override fundamental technology shifts. Strategic venture investing is powerful, but not omnipotent. It works best when aligned with a strong core business. When the core business weakens, strategic investing faces harder challenges. Intel Capital demonstrates that corporations can invest successfully in startups if they play to their unique strengths. They cannot beat pure financial VCs at the financial game. But they don't need to. They have different advantages: technical expertise, customer relationships, market access, patient capital, strategic alignment. Leveraging these advantages creates value that pure financial investors cannot match. The story also illustrates how technology ecosystems actually develop. They're not purely market-driven. Large companies with strategic capital shape these ecosystems significantly. Intel Capital funded hundreds of companies that built the internet infrastructure, cloud computing platforms, and AI applications we use today. These technologies might have developed differently without strategic corporate investment. Market forces alone don't tell the full story. For society, Intel Capital's impact is mixed. They helped build enormously valuable technologies that billions of people use. They created wealth and jobs. They advanced innovation. but they also reinforced incumbent advantages and potentially limited competition. They helped Intel maintain dominance longer than pure market forces might have allowed. Whether this is good or bad depends on your perspective on corporate power and market competition. The human story behind Intel Capital is equally important. Les Vardas, Arvind Sodhani, and hundreds of investment professionals built this institution. They made thousands of decisions. They took risks. They learned from failures. They built relationships. They adapted to changes. Their collective work created something larger than any individual could achieve. This is how institutions are built, through sustained effort over decades. What will Intel Capital's legacy be in 50 years? If Intel recovers its competitive position, Intel Capital will be remembered as a strategic weapon that helped Intel maintain dominance across multiple technology eras. If Intel continues struggling, Intel Capital will be seen as a successful program that couldn't overcome its parent company's challenges. Either way, Intel Capital proved that corporate venture capital can work if done with strategic clarity and long-term commitment. The lessons from Intel Capital's journey apply beyond investing. They speak to strategy, patience, adaptation, and the importance of maintaining mission clarity through chaos. They show that success comes from understanding your unique advantages and building everything around those advantages. They demonstrate that long-term thinking creates opportunities short-term thinking misses. They prove that relationships and ecosystems matter as much as individual transactions. Intel Capital's story is still being written. The program continues. New investments happen weekly. Portfolio companies succeed and fail. Intel's competitive battles continue. The ending is not yet known. But 3 decades of history provide enough evidence to assess what worked, what didn't, and what it all means. In the end, Intel Capital represents an experiment in strategic capitalism. Can a large corporation use venture investments not just to make money, but to shape markets in their favor? The answer is clearly yes, with important caveats. It works when the corporation has genuine strategic advantages to offer. It works when strategic focus is maintained. It works when time horizons are long. It works when relationships are prioritized. And it works best when the corporation's core business is strong. The experiment succeeded for Intel Capital across 3 decades. Whether it continues succeeding in the next 3 decades depends on variables largely outside Intel Capital's control. Intel's competitive position. Technology platform shifts. Geopolitical developments. Market conditions. But the model Intel Capital built, the lessons they learned, and the ecosystems they shaped will endure regardless of what comes next. That is the real legacy. A proof of concept that strategic venture investing can create value that pure financial investing cannot match. A demonstration that patient capital and strategic clarity can survive chaos and generate both financial returns and strategic benefits. A model that dozens of other corporations have studied and adapted. That is what Intel Capital contributed to the business world. That is what their story teaches us.